To achieve success in any venture, it's important to start by studying its fundamentals. One good way to begin learning Forex trading is to study currency pairs, specifically major currency pairs. The most popular and commonly traded currency pairs are called major currency pairs or majors for short. But before we get into them, let's first understand what a currency pair is. All financial traders aim to profit by speculating on the changing value of an instrument, such as the price of a company's stock or the value of a commodity. When trading in Forex, you speculate on the value of one currency relative to another. So, what is a currency pair? In simple terms, a currency pair represents a pair of two currencies, the value of which is expressed in terms of how many units of the first currency, the base currency, is worth in relation to the second currency, the quote currency. For example, if the exchange rate of the US dollar to Japanese yen pair is 113.00, this means that one US dollar is worth 113.00 Japanese yen. Learning about major currency pairs is a great starting point for anyone interested in Forex trading. Understanding the pros and cons of trading the majors can help traders make informed decisions when it comes to choosing the best currency pairs to trade. Let's talk about how to read Forex currency pairs. If you look at the current prices in the MT4 or MT5 trading platform, you will see a large number of Forex currency pairs. Each currency has its own three-letter ISO symbol. For example, GBP, British Pound, USD, US Dollar, JPY, Japanese Yen, CHF, Swiss Franc. Assuming you believe that due to low inflation in the Eurozone, as well as the high likelihood that the European Central Bank, ECB, will start implementing a looser monetary policy, the euro will begin to weaken. In the list of currency pairs, you will find that the euro is quoted against both the US dollar, EURIST, and the British pound sterling, EUR/GBP. The advantage of trading on Forex is that it allows you to choose against which currency, in your opinion, the euro will weaken the most. Suppose you anticipate that the US dollar will strengthen against the euro because the Federal Reserve is likely to tighten monetary policy, unlike the ECB. The currency pair that you should pay attention to in this case is the euro against the US dollar, EURIST. In the trading platform, the rates at which you can trade are listed to the right of the symbols. Bid is the price at which you can sell the currency pair, and ask is the price at which you can buy it. They are also known as the bid and ask price, or the selling and buying price. The difference between the two prices is called the market spread. The Forex market is the most liquid market in the world, but the majority of trading activity is concentrated on just a few currency pairs. The euro to US dollar pair, euro to US dollar, is the most liquid currency pair in the Forex market. There is no official list that separates currency pairs into major or best pairs, but conventionally, there are major, minor, and exotic currency pairs. Major currency pairs refer to the 6 most actively traded currency pairs. Australian dollar to US dollar, Australian dollar against the US dollar, euro to US dollar, euro against the US dollar, pound sterling to US dollar, British pound against the US dollar to Canadian dollar, US dollar against the Canadian dollar, US dollar to Swiss franc, US dollar against the Swiss franc, US dollar to Japanese yen, US dollar against the Japanese yen. It is not surprising that the currencies of the largest world economies make up these major Forex pairs. The enormous volume of trade in goods and services carried out in these countries is one of the reasons why their currencies are traded so actively. Another reason is the political and economic stability historically associated with these currencies, which increases their attractiveness, especially in times of economic instability. The US dollar, USD, is particularly popular, given its status as a reserve currency for central banks around the world, and because many key commodities, such as oil, are priced in US dollars. Therefore, the use of this currency is required to carry out such transactions. The euro, is the second most popular currency among institutions and governments. It is not surprising that the currencies of the largest world economies make up these major Forex pairs. The enormous volume of trade in goods and services carried out in these countries is one of the reasons why their currencies are traded so actively. Another reason is the political and economic stability historically associated with these currencies, which increases their attractiveness, especially in times of economic instability. The US dollar, USD, is particularly popular, given its status as a reserve currency for central banks around the world, and because many key commodities, such as oil, are priced in US dollars. Therefore, the use of this currency is required to carry out such transactions. The euro, is the second most popular currency among institutions and governments. There are various advantages and disadvantages associated with trading currency pairs, but the undeniable advantage of major forex pairs is their popularity. News about these pairs comes out much more frequently. Economic updates on major economies come out regularly, and they are closely watched in the market, giving traders the opportunity to predict sharp price movements. However, this requires a lot of work, as traders must constantly keep an eye on news releases, economic announcements, forecasts, and other types of data while simultaneously monitoring the fluctuations in the currency pairs they have chosen. Therefore, one of the main disadvantages of trading on Forex is that it requires a lot of attention and regular research, and even in this case, there is no guarantee that it will bring traders high profits. For example, the monthly report on U.S. employment by the U.S. Bureau of Labor Statistics is one of the key financial news in the economic calendar. Strong wage growth in this report is considered a sign of overall economic growth. This increases the likelihood that the Federal Reserve will tighten monetary policy, which in turn will lead to a sharp rise in the US dollar, all other things being equal. The enormous liquidity of Forex majors brings more than one advantage. Since transaction costs decrease with larger trading volumes, more liquid currency pairs have much narrower spreads. Greater liquidity also contributes to lower volatility jumps overall. Which currency pairs are the most volatile? In 2021, the most volatile were exotic currency pairs, US dollar to Swedish krona, USD/TRY, and USD/BRL. Among cross-currency pairs, GBP/NZD, pound sterling to Australian dollar, pound sterling to Canadian dollar, and pound sterling to Japanese yen are the pairs with the highest volatility. It should be noted that even the most liquid currencies can be volatile in certain circumstances. Volatility itself can be considered a downside for short-term forex traders. If they are unprepared or unaware of sudden changes that may occur in the market, they can lose a significant amount of funds. High liquidity in the forex market, especially in major currency pairs, makes trading a straightforward task. However, low liquidity in financial markets can sometimes make entering or exiting a trade difficult. One potential downside of trading on the forex market is the inability to earn regular, reliable, and fixed income that you typically expect from other types of investments such as stocks or bonds. It all depends on your perspective. For some traders, the forex market simply does not generate enough profit compared to the risk, but for others, the short-term nature of the market is a plus, as it allows them to earn a lot, or lose a lot, in a short amount of time. Prospect is the main factor in deciding whether to trade on the forex market or not. Are major forex pairs a good way to start trading? A good way to start trading in forex is to start with what you know. If you have an understanding or familiarity with a particular economy, you may naturally prefer to trade its currency, even if it is not part of the list of major currency pairs. Overall, the advantages we discussed earlier include narrower spreads along with a greater amount of forex economic news and analysis. This means that major currency pairs are a good way to start learning about the forex market.